Good morning, this is David Moore of Equity Advantage, and today's webinar is on when 1031 exchanges and Universal Exclusion collide, what happens? Got a little housekeeping to get started here. We've got a menu off to the right side, a control panel there. I'm not going to be entertaining verbal live questions, but if you've got questions, you can log in on the side there under the questions, type them in. If it's something to cover, I'll defer it until we get to that section. If it's something that's pertinent at that moment, I'll address it immediately. Otherwise, we'll be responding at the end for those that want to hang out, or sending them out with the credits at the end, which leads me to credit hours for this webinar. If you need or want credit hours, this is good for one Oregon credit hour of CE. And you can respond to C Moore, C-M-O-O-R-E, and send Celia, that's Celia Moore, send her your license information and she will send you certificates. And without further ado, we'll get started at this point. And I guess the only thing I'll add is that the only dumb question is one you don't ask. So if you've got a question, I understand sometimes people don't like to ask in front of a group. You're not doing that today. So if you got questions, please don't hesitate to reach out with them. We'll address them. So my background actually was real estate investment. I grew up in the Bay Area, moved to Oregon in 1990 to buy property, and we did what we could consider a modified flip. Flipping property, dealer status property, doesn't qualify for 1031. So not only do you not have the ability to do an exchange, but you're also going to pay normal income tax on a disposition. So it doesn't take long typically for people to figure out after flipping a few properties they're tired of giving all their money away. So with a modified flip, we buy things, fix them up, hold them. We'd rent them out for a period of time, do a cash out refinance. Maybe a year or two later, we then turn that property, but the money available via the refi is roughly what we probably would have been netting after paying taxes, but we still have the asset. So it really balls things up pretty quickly and makes things happen. But you know, the big thing today is in 1997, Section 121 replaced Section 1034, the residential residential rollover, I should say, not exclusion. Been a few years since I've been talking about exclusions, but that old rollover, you had a basis carry forward on things. And you think about people, a lot of times their first investment is their primary residence, and they grow out of it, and they slowly grow from a single family rental into plexes into other things over time. And you know, every time you're looking at a disposition of something, you've got to look at somebody's potential tax liability. And if we go back to Section 1034, for those people that were in the business pre-97, you think about that, we had a rule where you sold a property, you had 2 years to buy a new property of equal or greater value. And you could do what you wanted with the money in between. You just had to you had 2 years to buy. If you were 55 or older, you had a one-time lifetime exclusion of $125,000. Well, when the 250 and 500 of Section 121 came into play in 97, we were pretty happy about that. Those numbers meant something. But if we go forward to 2020 today, a 250 or 500 exclusion doesn't do much. So this presentation is all about keeping people's money theirs. And you've got a lot of situations people ask, well, hey, when should you think about an exchange, or put it out to your clients? And I'm going to say when you go to list a property, think about what's happening at that point. If you're the owner, anytime you go to relinquish a property, you want to make sure that you understand the tax liability of doing that before you actually sell it. So we have a situation today where the 250 or 500 doesn't cover much. So we have lots of scenarios where we convert a primary residence into an investment, or a portion of it. And on the flip side, there's lots of situations where people, especially, let's say, look at the political world we're in today, and you've got a situation where different governors or city councils are telling tenants that they don't have to pay the landlord. Well, if you're that landlord, nobody's telling you don't have to pay the debt service. So that's putting good people in bad spots. And so, once again, they might be in a situation where, gee, I don't really want to go out and buy another property. I want to get rid of this. I'm tired of the rental in this area. Maybe I want to buy a property to move into. And that's a situation where we're converting investment to residence. So this presentation, we're going to talk about converting investment to residence, residence to investment, and why you should look at doing those things. And the bottom line is, keeping people money theirs and moving forward, and that's the bottom line. So we've been, if I look at my history in the exchange business, been doing them personally, since the late 80s, but professionally since 91 actually, and so we've had lots of changes through the years. What used to be a lot of gain isn't today, and so on and so forth. But the bottom line is, think about this stuff. Think about Section 121, 1031 when you go to list a property or sell a property. Understand what the tax liability is going to be, and see if we've got a way to keep your money yours. And that's the bottom line. We as an exchange company, really our job is to keep our clients' money theirs. So we like to say, you worked hard for your money, we work hard to keep it yours, and that's basically the way we look at it in here. First thing I want to cover, we did have an extension for Section 1031. So historically, if you look at 1031, the biggest problem with any exchange is time. That 45-day ID period goes very quickly. The 180-day period can go very quickly. It's not a problem as anywhere near as often as a 45-day. But our position on these things today is that you get that 45th day, you've got to look very hard at whether you want to go forward with a transaction. If you're not convinced you are finding properties and you think, gee, maybe I want to just pull the money out, you've got to decide that inside that 45 days, because if you ID properties, we're going to have that money till day 181, and you might find something before that date that you'd like to buy, but if it wasn't identified on that 45th day, it's not possible, and we can't release the funds. We have a slide in here talking about when we can get funds out of an exchange, and we'll talk about that a little bit further, but we'd never had an extension on 1031 until 9/11. Since then, anytime there's a presidentially declared national disaster, we get some type of relief. And this is what they did. I'm not going to spend much time on it. This is the frame that talks about how people are impacted, what people are going to get some relief. And you can take a look at that. If you've got clients, or you are personally an investor and you're in an exchange right now, this is in a nutshell what it's going to cover and what kind of extension you're going to be looking at. We're about out of that already, actually, with respect to new transactions that are going to be coming in working on things. But be aware, this is what's here. This page gives a few different examples of different scenarios and how they would be treated and whether they're getting an extension in the 45 or 180. So the biggest thing, think about what you hear. Everybody on this call or on this webinar probably has seen ads on TV, heard ads on the radio, talking about tangible assets, inflationary hedges, talking about precious metals, silver, buy gold, all these things. Well, what are those? They're tangible assets, inflationary hedges. And what's everyone on this call work with? Real property, which is what? A tangible asset, inflationary hedge. And the interesting thing to me about real estate or real property investments is, in the Wall Street world, real estate, or even gold, precious metals for that, for that purpose, is considered to be an alternative investment. Alternative investment to me makes it sound sort of lesser than, but I'm going to say it's not an alternative investment. I'm going to say real estate is a real investment. The bottom of that page, it says that in bold. And it's a tangible asset. Unlike precious metals that have to go up to make you money, real estate doesn't. We've got cash flow, leverage, interest deductions, mortgage pay down, depreciation, appreciation. And at the end of the day, you have the ability to kick the tax liability down the road via 1031. Now think about Wall Street and what happens there, your ability to defer taxes. So real estate gives you all these different benefits. And at the end of the day, it doesn't have to go up. Even metals, precious metals, have to go up to make you money. And if you look at the quoted prices and what you actually get on that stuff, it's a totally different thing. But in the real estate world, real property, we've got the ability at the end of the day, people say, well, gee, why should I do an exchange at this point? I'm going to have to pay the tax at some point anyway. And my response to that is, well, swap till you drop, and that tax liability, capital gains tax liability, goes away entirely. Your heirs will get a stepped up basis, current market value at the end of the day. So unlike a retirement account, think about IRAs and 401k plans, and you think about the scenario there. You've got money that goes in, you're basically giving the money to somebody else for many, many years to make it grow. And at the end of the day, unless it's a Roth IRA, so just just for in the best interest of everyone on here, a traditional IRA is pre-tax money growing tax deferred. Roth IRA is tax money growing tax free. So you think about any retirement account, IRAs, 401k plans, you're growing all these investments, and in the day you're paying normal income tax on any distribution at the end, when those things have been fully recovered, or you reach that 59.5-year-old point where you can get access to that money without penalty. But 1031s with property, with money out of your pocket, once again, we've got the ability to swap till you drop, or maybe exchange into a retirement house, and we can once again eliminate any tax consequence through the entire investment life. So it's a very, very unique thing. Great opportunity. I think it's the most powerful investment tool really available out there. So what's gain? And going through times like we're in, hopefully we don't see what we saw a decade ago, but that last crash, we had a lot of people that were rudely awakened to a situation where even with a short sale or foreclosure, they were realizing gain. That's called phantom gain. So if we look at gain on a property, on a disposition, it has nothing to do with profit. Gain's simply a tax calculation. It's the difference between the basis and the adjusted sales price. Your basis in a property is what you paid for plus the capital improvements minus depreciation. That sounds simple, right? Sounds very easy. The purchase price, well, it's not that easy. How did you get that property? If it was gifted to you, your basis is a person's basis that granted that gift to you. If you inherited it, as I just stated, you get a swap till you drop. At that point, if you inherited the property, your basis, the initial purchase price, let's say, is the value of the property at the time you inherited that thing. If we had Section 1034, pre-1997, like I said, we had that situation where you had 2 years to buy a new home of equal or greater value. That's a basis carry forward transaction. 1031, once again, the gain goes forward, basis carry forward. 1033, involuntary conversions. Let's say your own property in a city, state, county, somebody's condemning the thing, taking it. Well, you get that basis carry forward. You've got a different set of rules. 1033 works similarly to 1031, but you don't need us, and we've got extended timelines. But that's another presentation, another conversation. But all of those things are going to impact that initial quote unquote purchase price. Now we looked at improvements, and I'll talk to somebody. I talk to people all day long, and I said, well, okay, you paid this for it during the time you've owned it. Have you done any work to this thing? And they said, yes, I did this, all these different things. And the bottom line is we take a look at that, and it's like some of those things are capitalized and some are improved. So what's the difference? Or capitalized or expense? Capitalized means it's going to be added to the basis, increase your basis, and you're going to get that benefit of an increased basis with the capitalized improvement. Expense items you're just writing off. So I'll talk to people and say, well, hey, did you do any work to this property during the time you've owned it? Yeah, I did all these different things. We need to write them off. Oh, I wrote everything off. Well, okay, you had a situation where you expensed everything. It didn't increase that basis at all. So if you capitalize it, increase the basis, you expense it, it doesn't. Depreciation. What's the government's position on depreciation? Lots of times people say, well, hey, I have a rental house, but I never took depreciation on it. Well, depreciation is not an optional thing. If you should have taken it, you therefore did in the government's eyes. So once again, good tax people. We're just one member of a good team of investment professionals. So you're going to have good tax and legal people on that team, people you're paying for an opinion on stuff, not paying to learn, brokers, obviously, title escrow people, finance people, property managers. It's a complicated world today, and take advantage of the resources at your disposal. Let everyone do their job, and you're going to get where you need to be on these things. But when we're looking at, I think a lot of cases that tax person's one of the most important, if not the most important person in somebody's life today. You think about what's going on with the property, how the government's doing everything they can to take that tax revenue, and a good tax person is going to be doing everything he or she can to keep that money yours and keep it growing. So, once again, you're going to look at this. When do you want to think about an exchange? I'm going to say ultimately when you're looking to buy something, but at latest when you're, before you ever list a thing, when you contemplate a sale, at that point, talk to your tax people, understand any potential tax liability on disposition, understand what you're doing and where you want to go at that point. And by all means, the timing, as we said, is the biggest issue with any transaction. If I came to came to you and you happen to be a broker and said, hey, I'd like to list this property for me, and tomorrow you call me up, you got an all cash offer on the thing they want to close it Friday, your response is great. Initially anyway, until we figure out that I have no idea where I'm going and I don't want it to close Friday. So you got to ask and time these transactions. Biggest obstacle with any exchange is time those transactions. Now, if we go back to this basis and gain situation, phantom gain is one of those problems. And as I said, the last crash, we had a lot of people sort of get awakened on this. And I think the same thing might happen here if we've got a continuation of if this is a slow recovery instead of a quick one at this point in time. But we look at phantom gain, or the sales price in a foreclosure or short sale. You look at a situation where the sales, quote unquote, sales price is either the debt or the sales price. And when we're looking at a short sale, the debt on the property can actually exceed the basis, and that would be treated as a sales price. So if the debt on an asset exceeds the value of it or that sales price, they're going to look at the debt as that initial calculation number. So unfortunately, what was happening is we'd have a foreclosure and the property would go away. Our client didn't receive any money, and they were saying, well, gee, how can I have any gain? I didn't get any cash out of the transaction. In that situation, we're isolating the taxpayer from actual or constructive receipt of the debt relief, and that's what's going to trigger the gain. So once again, proceeds from a sale have nothing to do with gain. It's simply a tax calculation. Phantom gain occurs when you've got a short sale or a foreclosure. The property goes away, you have no cash. And a lot of times we do exchanges in these situations because what we're doing is isolating the taxpayer from the gain in that scenario. And if you look at the tax liability on that disposition, it might be in excess of what it would cost to go out and buy a new property of equal or greater value. And I'm talking value as in the debt on that relinquished property. So we did a lot of those transactions. Really, we were cleaning up some of that mess until I think our last phantom gain scenario with a institutionally offered asset was probably in I think maybe late 2018. I don't remember if we did any of 2019, but we come up with a process and we did a lot of those bailouts through the last crash. And I hope I don't see any of these things going forward now, because it's just no fun to be working that scenario. Section 121, Universal Exclusion. So every time you go to sell something, if you're a broker, think about 121, think about 1031. If you're an investor, think about these tax codes. Understand, if I sell this thing today, what's my tax liability? Do I want to pay that tax? If I don't want to pay the tax, what options do I have? So 121 came in, replaced Section 1034, and basically what it says is if you've lived in a property for an aggregate of 2 out of the preceding 5 years, an individual gets $250,000 in gain, a married couple gets $500,000 in gain. You can do this over and over again. That's just got to be separated by 2-year increments. And actually, it says it's application to one transaction every 2 years. That's not entirely true. You can have multiple sales as part of one action, and as long as the aggregate of the multiple sales, maybe you had a bigger property that was your home, and you broke off a piece, sold it, and then you sold your home. As long as you're selling both within that allotted 2 out of 5 where they both qualify, you are allowed to have multiple sales. More often than not today, though, instead of having multiple sales fitting towards 121, what we're doing is splitting off a piece of it and going 1031 on it, and then going Section 121 on the balance of it. So you can, if you didn't catch that, you can have a single asset with allocations 2 different directions. So, we're just looking at allocations and massaging numbers one way or the other to make sure that we're keeping our clients' money theirs. But this works pretty well. The numbers are getting leaner and leaner. I mean, if you think about somebody in California, Washington, Oregon, DC, any high dollar real estate, does $500,000 for a married couple do a lot? And once again, I want to stress this is every 2 years you can do this. It's not a one-time deal. But it's one of those things where we used to have people exchange into a property, hold it for, let's say, a year, move into it, live in it for 2, dump it, take the exclusion, get rid of all their gain. We can't do that anymore, and we've got some, we're going to talk about converting assets, seasoning things to convert them, and why you're going to want to do that. But we can't exactly do that transaction anymore, thanks to the Housing Assistance Tax Act of 2008. And I always jokingly say, you got to love the way they name this. All it does is stick it to the taxpayer. It doesn't help them in any way, obviously. But this thing works pretty well. And like I said, you're not pigeonholed into a one-time application. You can do it over and over again, just have to separate them by 2 years. 1031, been around since the 20s, all right? So it's not new by any means. It's been there. We did lose personal property with tax reform. So in 17, when we got tax reform, we used to do lots of exchanges of personal property, aircraft, collector cars. We had people doing all kinds of artwork, businesses. We did a lot of dental practices even. And we used to be able to do exchanges on that stuff. Today, we can't do exchanges on personal property. It's just the real property. So keep that in mind. And as far as that real property, we're just going to look at it and sort of apply what we can, whether it's 121 or 1031 or 1033. And once again, our job is to try to keep the taxpayers' money theirs and keep them going where they want to go. But this is something that is attacked every few years. And I'm really honestly getting a little bit tired of trying to defend the process. It's, I believe, one of the most powerful tools any investor can use. And the bottom line is, look at every dollar you save somebody, you've got 3 or 4 more to reinvest, just with financing and loan to value that way. So one sale and tax consequence can really make a huge difference, put you way behind, where if you keep working it, you can swap till you drop and you really grow, snowball your investments and make them grow just like any IRA 401k. But at the end of the day, you've got a much better situation in that you're not looking at normal income tax at the end of the day. So anytime you're going to sell a property, pull this frame out. Look at this slide. You're just going to say, okay, 121 is this, section 1031 is this. What potentially falls between those two codes? Something that hasn't been held enough to fit section 121. So you're not allowed, let's say after years residency, you can't just electively say, okay, I'm going to take half the exclusion. Now there are a hardship for sale that can give you prorations of the 250 or 500. So once again, who's going to help you with that decision? That all important tax person that I talked about. So once again, you have to have lived in it for 2 out of the preceding 5 years. It's not the 2 just immediately preceding disposition, it's any 2 in that period of time. 1031 applies to what something is at time of disposition. So 121, you have a straight exclusion on gain. Doesn't matter what you buy, you get the 250 or 500, you can go over and over again. 1031, it has to, if something's held as an investment at time of disposition, that's what it's got to be to do an exchange. And then doing the exchange, you've got to receive something of like kind. We need to go across or up in value and equity. The toughest thing is the 45-day ID period, the 180-day total time. The next biggest headache we have is vesting with the exchange. And that just means that the person or entity that gave us something has to be given something back. So this is just those 2. Take a look at it. Anytime you go to sell a piece of property, look at those, see what you think it is. Well, what happens if it's, let's say that farmhouse with the farmhouse and the working land, once again, like I mentioned earlier. Well, we're going to have an allocation of the farmhouse. It's going to go 121. The balance is going to go 1031. What about a duplex, fourplex? It's a portion owner occupied. Same exact scenario. What about this? Think about the situation we've all been seeing the last few months. Lots of people working from home. Let's say people are working from home. They've had a home office. They treat it as a home office. Well, is that something that fits section 121 or 1031? That home office, if you've been treating it as such for more than 3 out of the preceding 5 years, that thing has to be treated as investment property. So you're either going to do an exchange on that portion of your home, or you're going to have tax liability on that disposition of that portion. So once again, talk to your tax people. And if you're taking advantage of the home office situation, or you're thinking you're going to do it going forward, just be aware that upon a future disposition of the property, you may or may not be looking at section 1031 for that component of that sale. So once again, you're not looking at all 121 or all 1031. It can be split. You can single asset allocations, different directions. You can convert an investment in a residence into investment over time. And 121 applies to anything that's fit out of it, could be a rental. And think about this: if you go to sell a property and you have it was your residence, you moved out of it, now you're converting it into an investment property. If you want to take the exclusion, which is many times the exclusion is a better situation, well, if you're a broker or if you're the owner, you need to look at it. If you moved out of it and you've got up to 3 years to sell and take the exclusion. So you're now in a timeline where it's really important. You need to be able to look at this and say, okay, what is this thing at time of disposition? What I really want it to be. If I take a listing on a property and the taxpayer's been out of it for 2 years and 9 months, I know I've got 3 months to sell this thing, and that would still entitle them to take the exclusion. The overage or anything that's going to have tax exposure would then be 1031. If we're talking about a conversion of an investment property into a residence, then we've got something called the Housing Assistance Tax Act, as I said earlier, that really sort of ties our hands in that situation. We will talk about in depth that topic. So this just look at it every time you sell a property. What am I selling? What do I want it to be? Is it one or is it both? Could it be both? Do I want it to be both? So once again, we're just saying, okay, these are 2 tax codes. What can we do to keep people's money theirs and get them going forward? And once again, keep that hard-earned money yours and working in the right direction. Conversion of a property. So as I said, you can take an investment property, convert it into a residential property. You can take a residential property and convert it into an investment, and there's reasons to do both. And a lot of times people say, well, gee, you know, I've heard you've got to hold a property for 2 years to have it qualify for 1031 treatment. It's entirely wrong. If in a related party transaction, if I want to do an exchange with my brother, there's a 2-year, it appears even in that scenario, it appears that there's a required 2-year hold in that situation. But if I can document there's no intent to avoid tax, even in this scenario where we've got a related party transaction, the 2 years doesn't actually apply. Now, 1 year's been proposed a couple times. The break between short and long-term tax rates on assets held for investment is at 1 year. I'm going to tell people that's what I'd like. I encourage them to hold it a year. It'd be nice. That's what I'd like to see. That's not my decision. It's up to the taxpayer and their tax counsel. But if somebody's telling you, hey, 2 years, I'm going to get you information on that. This slide torpedoes that, okay? The reason I said that 1 year is, as I stated earlier, the break between short and long-term tax rates on assets held for investment is 1 year. It's been proposed a couple times. But can you imagine, let's say you had a client or maybe you just bought a property downtown Seattle and now Seattle City Council has passed that ordinance that basically says, okay, the taxpayer, that tenant doesn't have to pay you rent from November through April. You couldn't evict them. Well, that's a real economic hardship. So say that thing, you bought the property in September, and a couple months later they passed this thing, and now you're looking, I go, I can't afford to keep this thing. Could you sell it? And I'm going to tell you, yes, you could, but talk to your tax people, understand in that situation is a hardship forced transaction. If you're asking me how long I'd like to see it, I'm going to tell you once again, a year. But in this situation, in this recent court case, you've got a scenario where 4 months was deemed long enough. People acquired a property with the quote unquote intent to hold for investment. They documented the advertisements, they documented the showings. After 4 months, they acquired the property. After 4 months, they moved into it, they got audited, they got taken to court, and they prevailed in court after a 4-month hold. Am I going to tell you 4 months is long enough? No, but in that particular situation, it was. We've done transactions where property was held even less than that, and people have done an exchange. So intent is much more important than time. Time is a factor, obviously, but most people, if they really understand the code, they're going to see at least different tax years. But it really has to do with your intention, what's going on with that property. Now, if we look back in the history of 1031, there's a court case where 5 years was deemed not long enough. And you're thinking, well, gee, you just told me 4 months was deemed long enough in court. Well, that 5-year situation was a situation where the people bought the property and put it on the market immediately. It took 5 years to sell, so they never held it for investment. So you've got to look at your intent and what you did with the property during the time you owned it. We've got a page that's talks about determining dealer status. We've got, we use the Clarkowski court case, 9 points used to determine dealer status. And we're going to go through those 9 points. If you've got, in that situation, if you are a broker, you've got somebody in that scenario, people that flip property, that's where they are. But you could be a dealer and you can have investment property and dealer property. You just got to make things fit. And if you've got a situation where you want to talk about that, give us a call. We're happy to review those situations, talk to you, and then we can get, you can take that information. You'll be armed with it when you go back, talk to your tax people. So in that bold, the bottom of that page, taxpayers' intent is typically much more important than even the length of time the property is held. Intent is what it is. The Housing Assistance Tax Act, as I said, this thing's titled like it's there to help people. It sticks it to you. So remember, I said earlier, we used to have a lot of transactions where we'd exchange out of a investment property into a new quote unquote investment property. The person holds it for a year or so, moved into it, and they'd sell it after living in it for 2 years. And it's a great scenario. So you're talking about it like a 3-year hold, and people just roll through a series of properties, eliminating all the tax consequence. Well, the government doesn't like seeing that. So they, in the early mid 2000s, we had a 5-year hold required hold put on a property acquired via 1031 converted to a primary residence. So that thing slowed the process down. The government saw that that still wasn't doing what they wanted to do. So in 2008, they stuck us with this thing. And this is really just a pain. And what it basically says is you can do, keep in mind, anytime we get rules on something, it does 2 things. It obviously ties our hands, but on the other hand, it ratified the process. So they've acknowledged that you can acquire something, convert it, and they've even given you timelines now where it's without question. But what this does is it gives you a proration of Section 121's 250 or 500. The proration is based upon the amount of time a property is held from 2009 to the date of sale, the qualified use versus non-qualified use period. So if you, let's say that you had a property all the way back into that 2009 time, you bought a property last year, and now you've converted it into a, let's say, a primary residence. So we had 10 years of non-qualified use. And now you're starting the clock. Now, I told you need to hold this thing for 5 years, right? So maybe you had 10 years of qualified use, and you get 4 years of qualified use, gets to the 5 years. But let's just go 5 so we're safe. We're outside that. Nobody questions it. So we had 10 years of non-qualified use and 5 years of qualified use. You're going to get that proration of the exclusion based upon the 5 versus the 10. So you're going to just get a fraction of that exclusion. You're not going to get that whole thing. The longer you hold it as a primary residence, the more of it's going to fit within the exclusion. So the more qualified use you have, you're never going to get entirely out of that picture, but the ratios will keep shifting more and more. So what I tell people, if you're just doing this transaction, wanting to acquire something via 1031, converting it because you think, hey, I'm going to get rid of all my gain. If it's an end game, you're going to plan to live there for the foreseeable future, great, do it. If you think you're just going to buy it, hold it for a couple of years, get rid of the gain, it doesn't really work that well anymore. Of course, you can do that and retire, and your income's going to be less, and maybe when you sell it, well, the taxes, when's the last time taxes are really going to, well, 2017, I guess, but it depends on your situation. Historically, we've got, obviously, inflation devalues the dollar. Typically, historically, where tax rates go up, but you just got to look at this and understand, hey, it used to be a great idea. It still is going to allow you to acquire something without a tax liability, convert it without a tax liability, but a future disposition. The bottom line is look at it, talk to your tax people before you ever sell something. If you think you're going to convert via, go acquire via 1031, convert it into Section 121, then future sale. Talk to your tax people. If you've got questions, you can talk to us. We'll send you some information. You can go talk to your tax people with that information. I like simple. So these are the basics, my 4 cornerstones of the exchange. And I used to have a good buddy that worked with us in here, and he always said, hey, I love that KISS principle. Keep it simple, stupid, right? So it's got to be an exchange. As far as you're concerned, you sell something, buy something, we turn in exchange. The items relinquished and received must be of like kind. We're going to talk about each of these. To be totally deferred and exchanging is not all or nothing, but to be totally deferred, you need to go across or up in value and equity between the relinquished and the replacement property. We call that the Napkin Test. And then finally, we've got to have continuity of vesting. The taxpayer that relinquishes has to receive the replacement property. As I said, you can convert things back and forth. And to qualify, a property has to have been held as investment at time of disposition, where Section 121, as I have been saying, just applies any property that you have lived in for 2 out of the preceding 5 years. So what's an exchange? Well, an exchange, people typically think of a true swap. And I had somebody the other day asking about this because their CPA was telling them it had to be structured as an exchange or they were going to have this big tax consequence. And really what happened in that situation is, if you've got a property and you're using it as consideration for another property, you're in a situation where a swap agreement will take care of that. You don't have to do, people think of an exchange today as a 3-way exchange, an accommodated transaction. You're using somebody like us, an intermediary, accommodator, facilitator. We are paid a fee to step into the transaction, turn it into an exchange. But in the most basic sense, you give us something, we got to give you something back. We're paid a fee to do that, to accommodate it. If we're looking at a true swap, you're just using a property as consideration, or your property and the other party has a property, and each property is of similar value and equity, and it's mutually beneficial, just a swap. If those numbers are similar, you can just swap those properties and no money's changing hands. You shouldn't have any gain if the value and equity are the same. On the other hand, if you've got a small property, you want to use it as consideration for a big property, well, you're going to use that property along with some cash to buy the property. You don't need to use a facilitator to get that in there. The PSA, the purchase sale agreement, is going to show, it just says total consideration. It doesn't say total cash paid. It could be any combination of things. If the seller doesn't want the property, that seller, let's say they're getting the larger property, they're getting your property and some cash, well, they'd have to use somebody like us to do an exchange going forward. And if they didn't want to receive that property, what's going to happen is we would warehouse the property. So the cash is going to come into us, the property would come into us, and we're going to hold the cash until acquisition's ready. The property is going to go away, and then when it goes away and we have the cash from that sale along with the cash from the initial sale, we can go forward. That's a warehousing transaction. Other examples of warehousing exchanges or improvement exchanges or reverse exchanges, where a taxpayer cannot legally have ownership of the new and old property at the same time. So swaps are a situation where you've got a property, I've got a property, we swap, and it's mutually beneficial, similar values and equities. That's a true swap. That can work. A delayed exchange is what we typically do today. You literally sell a property, buy a property, we step in the middle and turn it into an exchange. You've got 45 days from settlement of the first relinquished property to ID what's to be acquired, 180 days to get it done. You can give up one property, buy 10. You can give up 10 and buy one. A reverse exchange allows you to buy a property today to replace a property yet to sell. An improvement exchange allows us literally to build something. And we're doing a fair number of transactions where we're actually building on property that's already owned. That's a whole nother seminar, or webinar, but I'm happy to go over those things. Warehousing, once again, is anytime we're doing it could be a reverse exchange, it could be an improvement exchange, or it could be a scenario where a taxpayer is receiving something they don't want in the exchange. Anything that's boot, they don't want it. We have to convert that thing that's boot. And then once again, it could be the cash at any transaction triggers, or it could be an additional asset, whether it's a car or whatever might be used as consideration to buy that real property. Once again, I want to stress that we cannot do personal property exchanges anymore. Hopefully that'll come back someday. I blame the Opportunity Zone for the loss of personal property exchanges. But anyway, we'll see what happens going forward. So the exchange happens when the property is transferred, not when the sale occurs. Therefore, the item or items transferred dictate what must be received. So an example might be, let's say that you're doing an improvement exchange. You're doing what we call a leasehold improvement exchange, where you want to build on land you've already owned. So you've gotten this property, you've gone through all the plans, permitting, engineering, getting it all taken care of where you're ready to hit the go button. And think about a situation where, depending on where you live in the country, you've got climate that can dictate a big problem for construction. So when do you want to start that project? When can you get started? The exchange only allows 180 days total time to get things done. So you might be at a point in the year in which, if we're doing a leasehold improvement exchange and we've got everything set to go, we might start the project, start the improvements before your property ever sells. So that transfer date is going to be the date the exchange starts, not the date of disposition in that scenario. So once again, talk to us, ask questions. The only dumb question is the one you don't ask. So, got situation, you want to bounce off somebody, even if you're working with somebody else, give us a call. And a call, I said give a call because I'm just not a fan of obviously texting on complex issues, but even emails, we can go back and forth forever, where a phone call, we can take care of something very quickly. There's no cost or obligation to talk to somebody either. The like-kind requirement. Like-kind has never changed. I always joke, in 1991, I had a lot more hair on my head than I do today. But I had people in those days that say, well, I remember when it was house for house, land for land. It's never been that way. Like kinds always refer to the nature of the investment rather than the form. Any real property held for investment is going to be like kind with any real property acquired with the intent to hold for investment. So, typically we encourage people, like I said, to hold for a year or more, but there are scenarios where that's not something that's going to work for somebody. And as long as you're not creating a habit of the whole thing, you should be fine. But as the like kind, the like kind requirement is simply nature rather than form. So we can go from that rental house and the apartment building and the office building and the strip mall, the place at the beach to retire into. You're just looking at a scenario, you've given up property, you've held for investment, you're acquiring property, quote unquote, with the intent to hold for investment. And we can move from all those different classes of real property. The one item I want to point out is the item at 10 o'clock on this diagram. It says build a suit. Really, it's a 30-year lease. So a leasehold interest in real property, a lease with of 30 years or with extensions to 30 years constitutes ownership of real property. So we can do those leasehold improvement exchanges, or if we're buying property, quote unquote, buying property, let's say in Hawaii, where we've got land leases, we need to make sure the land lease is 30 years or greater, otherwise we're gonna have a problem. Anyway, if you've got questions on this, give us a call. We're happy to review that like kind and make sure we can help you get the pieces to fit if at all possible. The napkin test. This is one of those things where people continually get this wrong. People say, well, you have to replace debt in an exchange. You have to go across or up in value, equity, and mortgage. And that's entirely untrue. If you look at the bold, or not the bold, I'm sorry, the bold at the bottom is what is boots, anything that's received that's not of like kind in the exchange. The italicized information there, you may offset mortgage boot with cash, cannot offset cash boot with additional mortgage. What that means is debt can go away in two ways. Debt can go away by going down in value. It's going to trigger taxes because you went down in value. The other way debt goes away is by adding cash, which is totally fine. So that italicized statement, you can offset debt relief with cash. You cannot offset, cash received with additional mortgage. So the government has no problem with you putting money in, adding money to a transaction. They don't want you to pull money out without tax liability. So if you want to get money out of an exchange, you can only get that money at settlement or after you've purchased everything you have the right to buy. If you want to get money out of a property, you can do it pre-disposition, but do it before the property's ever on the market. If the property's on the market, or you get the refi and immediately put on the market, the government could say that's a step transaction. You did that to avoid tax. We don't like that. On the other hand, if you complete a transaction and then do a cash out refi after acquisition, that money is not going to be a problem for you. It's got to be a separate event. You couldn't have a, like a double escrow where you close and immediately that day get the money out. Give a couple weeks, it would be nice. And then you've got that money to work with as you choose. I often talk about the benefit of doing that too, because if you want to pull the money out through the exchange, you're going to pay tax on that money. You complete the exchange, bury all the money, do the cash out refi. Now you don't have to pay tax on that money. The other benefit of using that approach, let's say you're going to buy multiple properties and you want to leverage, and maybe you gave up a property that's owned outright. Let's do the exchange, acquire maybe a property to fully satisfy your exchange value and equity requirements. If you own that thing outright, then do a cash out refi after acquisition. And then the refi money is not taxable to you. You've eliminated the time constraints. Now you've got that money to go buy the other properties that you want to buy with the luxury of time, and whatever you buy, the basis on the additional properties purchased with the refi money is the purchase price. You don't have the basis carry forward out of that relinquished, spreading that lower basis across all those replacement properties. So that's something I really encourage people to do if at all possible. If you've got questions on that anytime, just reach out. But in a nutshell, the Napkin Test says we've got to go across or up in value and equity between the relinquished and the replacement property for total tax deferral. And it, once again, is not all or nothing. If you want to pull some money out, you can. You're going to pay tax on the money that comes out. Continuity vesting. Simple thing, you'd think, all right? And you got to look at a situation where, unfortunately, I've had transactions where people have quit their job in the middle of an exchange. It's hard to get financed if you quit your job. Now we're in a scenario where we've got lots of people who've lost jobs. Maybe they have to add a spouse. So think about a situation where you've got a property and you sell that property, it's just in your name, and you're married. Now you need the additional credit maybe to make that acquisition happen, so you have to add the spouse. Or you want to add the spouse. If you're contemplating a sale and only one of you're married and you've got a spouse and you want to put the spouse on title replacement property, you probably want to add them to the property that's being relinquished first. And you've got to look at that situation. And if you just take and add that person right predisposition, you got to make sure that you can justify that change. So what you're doing is, in effect, I would say it's a correction deed. You're going to go back to the taxpayer and the talk to the tax counsel and say, look, the exchange company said that I've got to have both people going forward if I need both to have the financing on this thing, and only I'm on the relinquished property. So, what I do when I'm talking to somebody, this is a question I ask every single person I'm on the phone with. How do you own that property? How do you want to buy the new property? If we're adding a spouse to the relinquished property, I'm going to say, okay, how long you been married? If they say, oh, decade, we've been married a decade, I ask, well, do you file jointly or separately, individually? They file jointly. Both parties, even though both have not been untitled, have been enjoying the benefits and burdens, and we don't have any, should have no issue adding that spouse. Once again, you want to talk to your tax people and make sure they're okay with it and explain to them why we're doing that. Now think about this scenario, and this is the other problem we have with this vesting issue, and this is impacted differently whether you're in a community or non-community property state. Oregon's not a community property state, so let's say you've got a rental house and you get another one, then you get another one, now you've got a half dozen of them. You talk to your legal counsel and they say, well, Lee, look, you've got a situation, you've got all these properties, and you've got more liability. How do we take care of you on this liability? And in that situation, we suggest, or the lawyer says, we suggest you put them into a limited liability company. Well, yeah, that takes care of that problem. That's great. But understand now, since you're if you live in Oregon, non-community property state, and it's a multi-member LLC, you need to go forward having continuity of vesting. The exchange requires that. And a multi-member LLC in a community in a non-community property state is literally a partnership. You cannot go through the exchange in and out of that partnership through the exchange. Where, let's say, California or Washington, a community property state, husbands and wives can go in and out of an LLC through the exchange. But once again, non-community property states, we have to have continuity of vesting. So when you're going to list the property, make sure the vesting on that property indicates how you're going to want to own the new property. And partnership interests are specifically prohibited from 1031 exchange treatment once again. This is the flow of a transaction. The taxpayers up top, we're in the middle. The taxpayer sells the property as they normally would. The brokers, you're going to list the property as you normally would. You're going to negotiate a sale as you normally would. You're going to go out and find a new property or properties to buy as you normally would. But the taxpayer gives us a property, we sell it, they tell us what to buy, we buy it, we give it back to them. So arrows 1 and 6 on this diagram, that's where the 45 and 180-day timelines come into play. Once again, both those timelines start at settlement. The 45-day period is, they both start at settlement. The 45-day period is the biggest headache. You've only got that 45 days to figure out what you want to buy. Phase 1 is what you're relinquishing. Phase 2 is what you're going to acquire. So if we look at actually, we talk about that napkin test and the value and equity requirements that are necessary. And Ron, you asked the question, when computing for the purchase price, we're going to look at the net of closing costs. Those value and equity requirements are going to be net of closing costs, not the gross. The closing costs, you've got to sort of break into two different groups. Normal transactional expenses can be paid with no tax liability. Elective fees cannot be. Even lender required repairs are not considered to be a normal transactional cost. So once again, my comment about tax people, I think they're one of the most important people in our life today. So you're going to look at things, and whether things are considered boot and taxable or just a normal transactional cost, either way, they're going to reduce what you have to spend. So once again, if you sell it $100,000, you probably got 8 to 10,000 closing costs. So your adjusted sales price would be 92. That's what you got to carry forward. If you had $20,000 in lender required repairs on that thing, well, that 20 is going to be boot, but it's the cost of closing. So once again, back to the tax people, they're going to treat that as boot received, but it is an expense of the closing. They're probably going to be able to offset the tax liability by expensing that item, and your net tax consequence should be close to zero. And on the bright side, you're not going to pay tax on both the boot received and the reduction, so you only have exposure once, so it does reduce what you have to spend. So your value and equity would be net of those costs. Finance costs on acquisition. Ron, you had that question. So it's the finance costs on acquisition. Once again, I'm going to break them into elective or required. Points are an elective thing. You can't go out and just buy points with the money without having tax exposure on that. Now, that's my position on this stuff. I've got lawyers that will argue an appraisal is not a normal transactional cost. Well, if you've got financing, that's not elective. You've got to have the appraisal. But if you want to be conservative, this lawyer's position is, well, it is a normal transactional cost if it's a contingency of the purchase. It's not if it's part of the financing. So, once again, we're looking at these fees. You've got a title escrow fees for normal transactional costs, broker's commissions, normal transactional costs. We look at the lending fees. We've got to look at that stuff. I'm going to say that the costs that you have to pay to get that transaction, you shouldn't have any issues with any of those. If you're buying points, other loan lock, those things, potentially they might have tax liability as boot received. Once again, they're closing costs, so you're going to throw it back at your tax people for the ultimate tax consequence of it. Either way, it's going to reduce what you have to spend. The 45-180, once again, you're going across or up in value and equity. You've got to do this in that 45. You got to find what you want within 45 days of relinquish the property. This diagram for Sunday says day 4. It should say day 45. You got the total of 180 days to get it done. You can change your mind anytime up until midnight, the 45th day. Identification just means you're giving what would be deemed an unambiguous description of the property or properties that you intend to buy. So this is the ID rule page. It's very convoluted. It's ridiculous. I don't know how they ever came up with these rules, but we're stuck with them. So Each rule works independently of the others. You don't have to work with them all. The first rule is the one that typically people use. You can ID up to 3 properties of any value. It doesn't matter at all the value number, you're just looking at 3. Second choice, you can ID more than 3. Total value cannot exceed 200% of the relinquished property's value. That page, if we look at the 200%, what is a property worth, I guess, number 1. Does a property have to be on the market to be identified? And we're looking at identification rules. If I go back to when we started the company, I had a 1990 audit manual that asked whether a property was on the market at the time of identification, which is totally irrelevant, unless you want to argue that all properties have to be listed with a broker to be bought or sold. So, for my broker friends out there, sorry, they have to be, right? Anyway. The bottom line is you're looking at, is a property worth what it's listed for, or is it worth something else? So I'm going to say, it's going to be worth what you're willing to pay for it. If you got a purchase sale agreement in place, obviously the number is going to be the number on that PSA. But other than that, you're looking at a value that you're looking at assigning what a thing is worth, to you. If it's on the market and you've got a PSA in place, go with those numbers. But you're looking at an aggregate of 200%, which really most of the time people are identifying properties, a primary with a couple fallbacks just in case. So that 200% rarely works. Third option, you need to ID more than 3 properties. Total value can exceed 200%, but you got to acquire 95% of the aggregate value of all properties ID'd. That gets cumbersome. Once again, because you're closing literally everything you ID. And once in a while, I hear we have a sale fail. Of course, I'm tongue in cheek there, but the idea is you've got to get these things done. And unambiguous means when you're IDing these properties, you're giving a description of an asset. If you're buying IDing a condo, it's got to be a specific unit. It could not be a unit of a complex. If you're buying a piece of a property, so a portion of it, you need to identify the portion you intend to buy. And it could be a common address as long as it includes city, state, and zip. It could be a legal description. Your purchase sale agreement in and of itself can satisfy the ID rules. When we put something together, you're going to get an ID pack, gives you the ID rules in a form to be filled out, mailed in, faxed in. Just get it into us prior to midnight the 45th day. This slide's very important in today's world. When can you get your money? Only after you've acquired all property you have the right to buy. So if you want to pull money out, you can pull it out at settlement, or you can pull it out after the 45th day if you haven't identified anything, or if you've identified and rescinded the identification. If you have ID'd properties and don't rescind the ID, and we are now outside the 45 days, that money is stuck here until the 181st day. This is not our rule, it's a federal guideline. Any exchange company that gives you money outside of what's called the 1031 G6 rules is not doing a defendable transaction. Their policies and procedures are flawed, and the government can actually nullify any exchange that company's done, not just yours. So this is something that came up a few years ago. We used to release funds at will, but when we got the guidance, we can no longer do that. End games: swap till you drop, exchange into a retirement residence, exchange till it makes tax sense, exchange into a passive investment, Delaware Statutory Trust, a DST, those are called. That's a place to go. Maybe you bought a property, City of Portland now has said the tenants don't have to pay, and you said, hey, I can't afford to keep the property, I want out. In fact, I'm done with these things. I don't want to do any more rentals. The toilets, trash, tenants, turnover. Well, maybe you go into a DST, okay? Installment sales, structured sales, deferred sales trust. Those three are basically different forms of installment sale. Talk to us about those things. You got questions. First thing I want to mention though is understand in installment sales, you got to make sure you're getting enough of a down payment to cover broker's commissions, the title escrow fees, tax legal fees, hour fees if you're doing exchange, and in installment sale, you've got tax on depreciation recapture and debt relief in the year of disposition. Even if you never received the principal payment, you're going to have exposure in those things, so be careful with those. CRTs, that's a charitable remainder trust. Lots of places will put those together, and that gives you some tax privileged treatment on a gifting scenario. Gifting, we have lots of people that buy properties maybe to buy, ultimately give to the kids. so you can buy something and transfer assets and take care of stuff. Oh, well, one other comment on the gifting. You know, the gift tax limit is 15 per person per year, at this point in time. It changes every few years. But if you look at gifting an in-kind asset, so if you gift a piece of a property, if it's minority interest, that gift can be valued at up to 40% of a reduction. So that's a huge opportunity for people. Be aware of that. So if you're taking, we use that process when we're doing distributions on IRAs and 401k plans. In-kind distributions of a piece of property. If you take a minority interest, you can take and discount that distribution by up to 40%, just like through gifting, you can discount that gift up to 40% if it's minority interest in something. Huge opportunity. Actually, I'm going to go back. This first option here, opportunity, this is a single asset sale, allocations, different directions. So we've got the farmhouse. I'm going to tell you, hey, talk with your tax and legal people, look at the exclusion, maximize the exclusion, anything beyond the exclusion limits, shove into 1031. So you're going to look at the value of the farmhouse or the unit that's owner occupied or whatever that might be, maximize the exclusion, and then take and throw the balance of it 1031. Works great, keeps people money, keeps people's money theirs and going forward. Sorry about that. Say that 10 times quickly. Example, and this is a situation where I think we're sort of going into it right now in these COVID times. You know, people might be tired of these properties, you know, especially if some politicians told the tenants they don't have to pay. 1031 is not all or nothing. Maybe you just don't want those properties anymore, but you don't want to pay the tax, you know, the full tax liability on acquisition. 1031 is not all or nothing. These people came into us, they sold a $3 million apartment building. All they wanted was a $1 million, I say all they wanted was $1 million property in the desert. So what we did is we did the exchange out of the $3 million apartment into the $1 million property in the desert. And you're going, gee, David, you just talked about the Napkin Test, which said they have to go across or up in value and equity. Yes, I did. And they're going from 3 to 1. They've got $2 million in boot on this transaction. Why would they do an exchange? Well, it's easy because their basis on the property going away was $250,000. So every dollar spent beyond the basis represents tax deferred gain. In this scenario, they gave up the 3, went to 1. The basis was $250,000. They deferred gain on $750,000. Still saved them $250,000 in tax. So get what you want to get. Every dollar you spend more than you want costs you $1. If you don't spend it, you're paying maybe 30, 35 cents in tax, depending on where you are and what situation it is. But understand the tax liability, then you can make an intelligent decision on what you want to do. This is a scenario where we're taking, these people got sent into us, referred into us by a law firm. He is a lawyer, she was a CPA. They understood what was going on. They didn't understand what their options were. We talked to them. They had a $3 million gain on the sale of a property, a primary residence in Los Gatos, California. We told them to move out of the property, establish it as an investment property. They did. They moved out. They pulled some money out, bought a new home. And then after they had held it as investment for a year, their tax people were comfortable in that situation for a year, they then sold the property. They went from $1 million tax hit to no tax exposure. They bought 24 different replacement properties, closed them all inside the 45 days. So we saved them $1 million in tax. They end up with 24 different replacement properties and the home that they really wanted. I think that's a huge win, huge opportunity. Got them all inside the 45 days because they didn't want a single sale fail, which would have triggered that 95% rule problem. And they were very happy clients. And you know, their world changed just with a few minutes of conversation on what they had and what they really wanted to be and how we could get them where they needed to be. This example is the same as the last one, so I apologize, but actually it's good because I've got one frame left that I want to cover and we're just a couple minutes beyond. So I'm throwing you a curveball here. This is sort of to entice you. We're doing a presentation on IRA 401k use with real property. If you're interested in those classes, please reach out to Seymour at IRAadvantage.net or at Seymour at 1031exchange.com. Should get you on the list for that also. But this is a situation where a husband and wife came to us. They're retired. They wanted to use their IRAs to buy a mobile home and RV park. And I said, okay, we can do a checkbook IRA for you, and you can do that. Well, then they told me they wanted to manage the property and they wanted to live there as on-site managers, and they can't do that with an IRA. But what we did is shifted gears in something called a rollover business startup. And a rollover business startup allowed this transaction to happen. So instead of using IRAs, we rolled their IRAs into a new 401k plan. We then created a C corporation. The plan bought the shares of the corporation. The corporation then bought the park. The park then employed them as the on-site managers. Therefore, their retirement accounts got an investment. They got a place to live and a job, all with this single transaction. I think that's a huge, huge opportunity for people, and it really totally changed their life. So, you know, ask the questions. Ask the questions. The only dumb one's the one you don't ask. And rarely is a question whether we can or can't get something done. It's a question of how we're going to do it. This page just gives you our contact information. If you've got questions, once again, please don't hesitate to respond or to send us an email with those questions. I've addressed the questions I got online. And I just want to stress, if you would like credit hours for this presentation, we are offering them for Oregon. We can't for Washington right now just because it's not a 3-hour class. And then as far as other states, if you've got a question on that, you can reach out. We can try to figure out whether or not we can get any credit for that. But if you're an investor, we look forward to working with you. Thank you very much for your time today. And best of health for everyone. And look forward to speaking again soon. Take care, and thank you very much.